Welcome back to my channel, guys, and this is video 2 of my series, An End to Bitcoin Maximalism. So in today's video, we're going to go over Bitcoin's design, the future, risks, and game theory surrounding Bitcoin, and the addressable market of Bitcoin, just everything in Bitcoin in general. So So one of the claims is Bitcoin has a max supply of 21 million. Bitcoin is designed perfect. It does not need upgrades. Bitcoin is free from censorship and has a maximum supply. It's perfectly scarce and does not need upgrades, and so does not need a process for decision making regarding upgrades. So that is the thought process. We're going to go over whether or not this claim is true or not for Bitcoin maximalism. Okay, so Bitcoin's design, it's proof of work mining rewards, mining control, governance, strengths, weaknesses, possibilities for the future. That's what we're about to hit. Okay, so how does Bitcoin work? Explained simply. So you have something called a repository. This is where the code is stored, and it allows for, so you have some version of code, and individuals can do upgrades to the code. And if an individual uploads their upgrades, and everybody that has access to that repository, everybody who has the keys to that repository agrees, the upgrades will get pushed in, and that will be the new version of Bitcoin if that was to happen. And then it happens again, and Bitcoin gets those upgrades, and then it happens again, and Bitcoin gets those upgrades. So this is the versions of the Bitcoin code base in this repository as it gets upgrades. So in time. Now people can upload all at once, and what you would do is you would everybody would test whether everything was compatible. So if, like, one of the reasons repositories are great is it doesn't have to be linear like this. A bunch of people can submit at the same time, and then the version could be see if it was compatible. In reality, it will get those uploads in a sequence, but like it'll have unique pieces of code each one, and so what they'll do is everybody will work to make sure it's compatible and that everything comes out working. So I don't want to get too much further into that, but that is what a repository is. It's a code base where everybody can work on it. Bitcoin is peer-reviewed and authorized. Certain authorized parties have access to this Bitcoin core, which is what the repository is called. And it's certain people that are respected that have keys and verify each upgrade with their keys. And so the mining community and everyone else who's involved with the Bitcoin community decides to use this version, this repository, for upgrades. And it's because it's the most respected. Miners choose this because it's the most respected reputation-wise. It's the most stable, most updates, and the most trust, and its position. Its position's not guaranteed, but it's the one that everybody has the most respect for. Now, what happens if this repository is deleted? That's fine, because everybody has a version of the Bitcoin protocol on their computers. So someone could just create a new repository, upload its version of the code, and then everyone would start using that one for upgrades. And whatever acceptable programmers would be in that repository, it would be a trusted community of key holders, and everybody would start using that version of Bitcoin. And so it would be, so regarding which version is used, it's whatever the miners decide to use. And Bitcoin's general design regarding what blockchain is actually made, like I said, I don't want to get too deep into this stuff, but it's the longest chain is what ends up getting incorporated into Bitcoin. So it's the most powerful computers, most powerful hash network is what ends up being the current blockchain of Bitcoin. And you can see right here that the Bitcoin Core is the most popular, and these other versions might be compatible or not, but this is the most widely run Bitcoin version of the code. So in order for it to be Bitcoin, in order for some code to be part of, like, if you want to be a participant in the Bitcoin network, you have to agree with the other computers. So if a computer comes and wants to join in the Bitcoin network and it has a version of Bitcoin, but it adds a few different lines, The Bitcoin code won't allow for it to be compatible because it's got to follow the rules, such as the block reward, the 21 million limit, and the block size, etc. Bitcoin verifies that in its own documentation so that if a computer is part of this network, these guys would not agree with it. So it would not be part of the Bitcoin network. But if he does agree to those rules, those basic rules that are in the code, then he can be part of it and participate in mining. So that's the way that works. So if you don't agree to the rules, you can't participate in the network. Now, Bitcoin is the most popular version. This makes Bitcoin's controls a democratic process. So Bitcoin network version is the network people agree on. So Bitcoin is a big network of people, and all these computers, like let's say Binance or miners or your wallet on your device or whatever, whatever software you're using, like some Bitcoin wallet, they're all using Bitcoin's code. And so this is a network of rules that everybody's agreeing to. And if the rules are different and they're all running a consensus, then there'll be a different version, like Bcash. Bcash is a fork of Bitcoin. There's a Bitcoin like this, and it went off in two different directions. Some people went with this code, some people went with this one, but they have the same origin. So it's the origin split, and some of the rules changed, and so Bcash is not agreeing to some of the same rules. And whatever version is Bitcoin is the one that everybody ends up deciding to use. Like I said, it's a democratic process. So when you buy Bitcoin, you're buying from this network, the largest network. You're buying from the largest network. But if you borrow from Bcash, if you buy Bcash, the token Bcash, it has less miners, it has less mining hash, and so it's a smaller network. But if it was to become bigger, then I guess everybody could consider that Bitcoin. It's whatever, it's what everybody considers to be Bitcoin is what is Bitcoin. So it's just agreed upon by all the participants. It's the most popular code. That's what Bitcoin really is. So Bitcoin can change in two different ways. It's called a soft fork and a hard fork. A soft fork is backwards compatible and it cannot break, but it cannot break the new rules. A hard fork is incompatible with previous versions, so it changes the rules. And whatever one, if there's a fork, this is a fork where the code splits, whichever one is more popular is usually what everybody has in their mind as the most is Bitcoin. So it would be the one with the highest price and the most highest hash. It doesn't have to be those things, but it's the biggest network, the most popular one. That's usually what people would consider to be Bitcoin. So one of the risks about Bitcoin is the risk of centralization of the mining pools. As you can see, there's not many mining pools, but these are more split than it looks. When I got into this research, I realized the risk isn't as bad as I thought it was, but there is a risk of a 50% attack. So that's if a mining pool ends up having 50% control of Bitcoin. So if this line was like this, and like this F2P pool suddenly got over 50%, they could do something like a 51% attack. Now, in a 51% attack, you can control over recent transactions. That's the most you could really do. You cannot do block rewards. You cannot make new coins. You cannot steal coins. You can only control recent blocks. And the network is visible, so it is very unlikely that this would even happen. This attack would happen because if everybody saw this was starting to happen, the miners' pools would change because they have a very high incentive. Their whole business is built around Bitcoin being divided, so they have no incentive to allow for such a damaging attack to take place. So it's very unlikely that it would happen. Now, that being said, Bitcoin is centralized in China. China is basically what runs Bitcoin. It's because they subsidize their energy production by the Chinese government, so they're basically the ones running Bitcoin, 80%. One of the things that I've learned early in life is something called the Pareto principle. You're always going to have 80-20, and that's always what happens in systems. And so China is the one that runs most of the Bitcoin network. So Bitcoin uses a proof of work algorithm for its consensus. This is the mechanism for how it is secure. So the pros is everyone can see what's going on. So there's not so the proof of work regarding the 51% attack is everyone can see what's going on. So it's very unlikely that attack would take place. Miners spend a lot of money and do not want Bitcoin price to dump. So Bitcoin, because their survival depends on it, they do have an incentive for the Bitcoin network to survive and for the 51% attack not to happen. The cons is proof of work is a very inefficient consensus method. It's very expensive. If you think about Bitcoin as a computer, it's like a few very small pieces of data in a transaction, and you're spending thousands of dollars for that small pieces of data. But the thing is that data has a trust associated with it, and that's what you're really paying for. You're paying for the data plus the trust. So miners want to maximize fees and do not care about efficiency. So that's one of the major cons of proof of work is miners don't care about efficiency. They have no incentive to be more efficient. They have all the incentives to charge and gouge and the community and to take as much from fees as possible. This is devastating for proof of work models. Miners only care about maximizing profits. They want to reach that point, and that's like all entities. That's fine, but their profits are directly contradictory to efficiency. So once again, proof of work is devastating for being efficient, and thus we have a devastating environmental impact. Now, whether or not you follow climate change, this is a contributing factor to that. Devastating environmental impact as long as amounts of energy are wasted doing useless work. So yeah, in a proof of work system, you're literally wasting energy. Whoever's wasting the most energy is the one that gets paid the most. It's kind of horrible. And this is not as big as a deal. I was saying like one pool could probably have 51% and hide it, but I don't think we could get away with that in today's internet. Okay, so yeah, Bitcoin's energy consumption equals that of Switzerland. Bitcoin uses 0.21% of the entire world energy power. And that's like with hardly anyone using it, or about a couple million people using it. That's very inefficient. That's devastating. Like there's no way around. Like this is a very negative thing for Bitcoin. And since that article was written, it's actually increased this difficulty of mining. And what this difficulty is how much energy expenditure is needed to provide this proof of work consensus. And at the time of the article, it was 0.1% of the world, and now it's getting up to being closer to 1% of the entire world energy usage. This is, that means a government can't really attack it, but at the same time, it's just wasteful. Okay, so this is bad. And it must remain why in proof of work systems to protect Bitcoin from nation state attacks, such as that 51% attack. But if a country was to do a 51% attack, everybody could see it. So like I said, 51% attack is very unlikely. So it's an important number to watch how much of the world's power is here, because that kind of gives you these idea of how much cost it would take to do a 51% attack. And so it's infeasible that a government would do such a coordinated attack and even be able to get away with it in an invisible way. It would be impossible. So proof of work, pros and cons. Once again, it's expensive. It's difficult to attack. More secure and larger value can be stored. Because it is expensive to attack, more value could be stored and used on it. And a 51% is very unlikely. The cons, it destroys the environment, and security is proportional to energy wasted. This energy should be put to something useful, in my opinion, and something that's neutral. Now, you could see this as pro or con, but the world's cheapest energy provider will control Bitcoin mining. In the end, given Bitcoin's design with this competitive environment towards with this difficulty of mining, whoever has the cheapest energy in the world is going to end up being the controller of Bitcoin. That's just going to be the way it is. And so you can see that as being a pro or a con. I couldn't find it if it was more negative or more positive in mind, so that's why I put it as neutral. You could see it both, pros and cons to that if you think about it further. So Bitcoin in the long run. So Bitcoin's inflation rate is going to continue to drop until it's nothing. Right now it's roughly 2%, or it is 2% or around that number. And it's going to drop to 1% in the next halving, and 0.5%, and then 0.25%. And there is now one of the things to consider is this inflation covers the cost of running the Bitcoin network, but there's also fees that cover it, and the fee ratio is dropping. The fee ratio is dropping for Bitcoin. it's, to get into what that is how much Bitcoin it needs to be used. So this is, in my opinion, this is a good thing. And what this is this right here is like the cost to do a transaction on Bitcoin. And Bitcoin was at 20,000 here, it's at 40,000 with this one. So it's showing that the ratio of a Bitcoin cent, so if you do $150 divided by 20,000, you get how much Bitcoin costs to do a transaction. With this newer value that Bitcoin's at is $125 divided by 40,000, the current price gives you the new Bitcoins it takes to do a transaction. So when Bitcoin is congested, it's really unusable by the rich, or it's only usable by the rich. The layer 1 is only really usable by the rich. But because of this, people are starting to move their Bitcoin off chain. The reason I'm talking about this, I'm about to get into, but I'm talking about dropping Bitcoin ratio for the fees over time. And one of the reasons that's happening is because Bitcoin transactions are moving off chain. Okay, so we're talking about Bitcoin in the long run. One of the reasons I'm talking about this is because I want to get into why this could be bad for Bitcoin in the long run. So in the long run, inflation will no longer support the network. The security will come from transaction fees. However, transactions are moving off chain. What does this imply? What solutions will be found? So if Bitcoin's inflation number doesn't cover Bitcoin to run, the network to run, to pay the miners, and if transactions are moving off chain, that implies that Bitcoin's security may be in trouble in the not so distant future. However, so I want to make the point that in the long run, Bitcoin is far from finished product. And people who claim that Bitcoin is secure with the way it is, they're not taking into account the not so distant future. This is beyond 10 years, but this is stuff that it could potentially be catastrophic. They may decide to do a perpetual inflation, or some other solution, because if Bitcoin remains expensive, once again the transactions move off chain, and so you're not going to support Bitcoin from inflation anymore, and you're not going to support it with transactions because the ratio is going to keep dropping. That means the overall cost for a 51% attack is going to keep dropping, and you could see the potential problem that could happen in the future. Okay, so I'm not going to go too much further than that, because this issue is about after 2038, in my opinion. And that's when Bitcoin's inflation is going to be really low. Even 0.5%, even 1.12%, I think that's enough. But when it starts getting to very low levels, there's going to have to be a solution, because the inflation and the transactions are not going to be enough to cover the network. So we're going to see how that goes. But we don't have to care about this until about 2028, because the real issue is about 2038. So they're going to only have to care about it about 10 years before this issue. And I'm sure at this point, everyone will have more information. A solution will come. So as an investor, we can put this concern out of mind. But I actually don't think it will be out of mind, because if this issue is not addressed, people will probably go to some other system, or, who knows what solution. The future is far from certain. People who think that Bitcoin has won, I don't consider 20 years out to be extremely far away. It is a big chunk of time, but when you're talking about the world's money, this needs to be addressed if you're going to make it the world's money. Okay, so Bitcoin scaling. So in my opinion, Bitcoin no longer has to scale. Other blockchains will do this for Bitcoin. And there is something that has been tried. It's called the Lightning Network, and it's a trustless P2P solution for Bitcoin scaling. It's a multi-signature address solution. Where it moves, what it basically does is it moves transactions off chain into a multi-sig wallet. Users will be set up their accounts with that, and merchants will set up their accounts with that, and it will report all their transactions. They'll have a bunch of transactions to Bitcoin in one simple transaction. So there's a bunch of transactions that happen up here, and then they send one transaction to the Bitcoin chain, so it lowers the cost of transactions for users. So the way it works is like if A wants to send money to B, if B is connected to the network of the Lightning Network, it'll find the route to B. But however, if you know anything about linear algebra or complex mathematics, finding the lowest route is a very difficult thing. So you need to have a map, and even if you do have a map, it's still complex. So that for that very reason, I don't think Lightning Network is going to get there anyway. If you know mathematics, you know that this isn't going to work. Because it gets exponentially difficult to find a route, the shortest path to a route, and I'll even get deeper into that. So A sends money to B through the shortest route. Everyone in payment channel must have the same balance. Oh yeah, and another thing, using the system, everybody's got to have a balance, and a key to be able to allow for this pathway. It just is not feasible. Okay, so must have a map of addresses in order to find the route through. So the routing path is handled by the sending node, which, like I said, mathematically gets exponentially more difficult as it finds the route to B, trying to find its way to B through the network. The network must be mapped every single transaction, and it's going to be constantly changing because all these paths are going to be opening up and closing, so there must be a map. Too much data for the network to process. White paper doesn't address routing that deep. Because there's always routes will be always opening and closing. So once again, I'm not going to dig too deep into this, but in my opinion, Lightning Network is useless. It will never get adopted. Okay, but that's just my opinion. Maybe I'm wrong, and I'm not seeing something that's going to be allow for that to work. Okay, so Bitcoin as a money or store of value. So let's explore that. In order for Bitcoin to be money, people must think about prices in terms of Bitcoin. Now, that's not as difficult as you would think, but let's go over some of the denominations. 1,000th of a Bitcoin is called a millibitcoin, and it's about $40. So a transaction in Bitcoin today costs about 3 millibitcoins. So in a practical transaction, I'm not willing to spend 1%. I'm only willing to spend up to 1% of my value if I want to do transactions. So to me, with 3 millibitcoins being a transaction on Bitcoin, 300 millibitcoin is the smallest the transaction I'm willing to make. And 1,000 millibitcoins will make you rich one day. So a third of what makes you rich as the most practical transaction doesn't make any sense. So Bitcoin is pricing out itself. Because of its expensive fee structure, it's pricing itself out of allowing the common man to think about it in terms of money. Because rich, a lot of people don't even in the world can't even do $40 transactions. Yet this 300 millibitcoin transaction, otherwise that fee, if you do a 30 millibitcoin transaction, you're going to be spending a 10% fee because of that 3 millibitcoin transaction. So it doesn't make any feasible sense. Like some poor people might do that if they do not understand the concept, but that's just not good. So as Bitcoin rises, if costs remain constant at, let's say, 1 millibit, then the more and more people are priced out of Bitcoin as the means of payment. So as Bitcoin goes up in price, more and more people are priced out. Once again, one transaction, 3.75 millibitcoin. So one Bitcoin send amount is 300 millibits. So if at today's price is 40K, 12K is the minimum that I would be willing to send across Bitcoin. Otherwise, I'm not going to send money across it because the ratio of fees is just too high for me. So if Bitcoin's $1 million, then the minimum fee, minimum amount I'd be willing to spend on Bitcoin is 300K. Because once again, and that's kind of ridiculous to spend 1% on that kind of money as well. So I might even move the price higher, like if I'm willing to move $1 million. So once again, this is showing, in my mind, that Bitcoin is only used, layer one is only useful to the rich. So 1/3 of a Bitcoin is least affordable amount at today's rates. So at today's rates, 1/3 of a Bitcoin is the most affordable, like the smallest transaction that makes sense because it's that 1% fee for me personally. And I know a lot of people don't want to spend more than 1% to send their money from A to B. So cost of transaction is basically 100x whatever the transaction is because that's my 1% fee amount. Another way to think about that, all of this is back at this problem, is the ratio is going to drop as transactions move off of Bitcoin into things like Ethereum. Like we already have something called wrapped Bitcoin. So like I said here, Bitcoin doesn't have to scale. Hopefully those fees will drop. But at the same time, if Bitcoin is no longer being covered by inflation and it's being covered by fees, and yet fees are dropping, the cost to attack the Bitcoin network goes down, but Bitcoin's network is worth more, so there's more of an incentive to attack it. So all of these things are really bad. The future is still unknown. We're still extremely, like, I don't understand how anyone can, it doesn't seem to be common knowledge. It is far from over. Like, saying that, Bitcoin has won this thing, to me, it's far from over. I'm still very bullish on Bitcoin, at least in the short run, at least for another decade. But it is far from over. This is a big story. Crypto is one of the biggest stories in the human condition, and it's far from over. Okay, so the high cost of sending Bitcoin ensures that Bitcoin will not be used as a currency. However, if price stabilizes and if people use second layer solutions, people may begin to price stuff in Bitcoin. So if there is a widespread blockchain like Ethereum and Ethereum scales, and we use wrapped Bitcoin, that could be the best outcome for Bitcoin, because then Bitcoin will continue to survive, but they'll have to figure out how to make it survive without fees. But once again, I'm going to divulge too much from that. But that Bitcoin could become a store of value on some other layer solution if that becomes widespread, and then people will start pricing everything in Bitcoin and it'll overtake. But like I said, we're far from seeing how this is all going to collapse out. So Bitcoin versus gold. So the Bitcoin network requires basic technical skills to use, requires network support fees, which is expensive running costs. There's no counterfeits, which is good about Bitcoin, and it's semi-private. Gold requires trust for large quantities. So gold is still a trust system. It does require paying for trusting some entity to guard it. The storage fees are relatively low. Counterfeit is a major problem with gold, so you have to worry about whether you're actually buying gold or not, and you have to verify it. And it's pretty private. So, those are the difference. I actually see a future for both of them. Okay, so Bitcoin governance. Miners control the mining version of Bitcoin software. In order to soft fork, a majority of miners have to agree. So, this is the way Bitcoin would be running, and the chain would split, and there'd be two different chains. Whichever one is the most used is considered Bitcoin. So it's a very democratic thing. That's something I like about Bitcoin. And the old version can still be supported. People can still support it, and then it'll split off and be called like Bcash or something else. So that's the way it works. Whichever one people use the most and pay the most for, and has the highest hash and the highest literal price, is considered Bitcoin. So balances up to the point of the fork. Everybody will have the same balances. So everyone will have Bcash and everyone will have Bitcoin if it splits and the community split. If you had accounts before, everyone would have the same accounts. But then things would start being different after the split. And you would have your version on each split of, you'd be part of this community. And you could sell whichever community you don't want to be part of if you want to exit that community. So majority hash is considered Bitcoin. Bitcoin's in people's mind, is the one that the minor hash has the most. So in people's mind, miners are in control of Bitcoin. If the hash was 50-50, it's a contentious hard fork, and would happen, and ultimately the bigger community would be considered Bitcoin, and only time would tell, but it could be like a fight between two communities, hypothetically. Like if Bitcoin was to split into 50-50, then they would be fighting over who's Bitcoin. Like it's clear now who's Bitcoin, but if this contentious fork was a 50-50, that would be the most contentious fork that could happen. Then they would be both fighting who's the real Bitcoin, like you can imagine such a thing happening. But yeah, for today, it's pretty strong consensus as to what is Bitcoin, because it has the most mining difficulty. If a proposal is not favorable to miners, it won't get hash support, and thus would not happen. So, for instance, EIP 1559 on Ethereum is a very popular proposal, but it's not popular to miners. Proof of work systems favor miners' profits over every other metric. Proof of work is devastating for efficiency, once again. So proof of work governance is not aligned with coin holders' interests regarding efficiency. Miners extract value from the system, in my opinion. We do need to move past miners. I would even like Bitcoin to do that if it could figure out a way to do it. I know that sounds crazy, but I just don't like how inefficient these things are, wasting huge amounts of energy. And the miners do not put their hash power behind anything that would increase efficiency, because they like extracting large fees. So can Bitcoin do anything blockchain is capable of doing? We'll explore this in the next video, blockchain design. We're going to be going over all the different blockchains and all their designs, and what the different optimizations of designs. So if you're looking forward to learning more about blockchains in general, stay tuned for my blockchain design video, which is next. Now, final thoughts. The future is extremely complex. Cryptocurrency is in its beginning. The store of value story is far from over. Like, it is not one. Bitcoin is not one, in my opinion, even still today. It sure looks like it because it's taking off. But I know that there's going to be conflicts in the future. It's just not designed perfect, in my opinion. And I hope to pass that idea to you today, like helping you see like there's still possibilities and risks in Bitcoin. But however, this technology is very transformative, and I don't know how it's going to unfold. I do believe Bitcoin will have a place in the future, a very strong place, because so many people are getting behind it, and it is a democratic thing. So whatever people decide is going to be Bitcoin. The truth is, people might decide to allow inflation in the future. It's whatever people decide. People might decide to get rid of the miners in the future, and that would be considered Bitcoin. This is all possibility. You could take Bitcoin on here, snapshot it to another blockchain, and burn the Bitcoin in the real chain, and everybody decides to use this other chain that's no longer proof of work. This is all stuff that's possible. Who knows what the future is going to happen? It is far from decided. It's far from over. Money is arguably one of the most important things about human beings. It's how we conduct all of our relationships. It's how we conduct our behaviors. So people who think that Bitcoin is all that matters are using old world thinking. Now that value is programmable, and iterations of human-machine relationships will develop at a continual and rapid pace. So it's a self-iterating process. We are evolving quickly in our relationship to devices, and those devices controlling human behavior, and in that relationship between human and machine. We must realize we know nothing about economics and even human behavior compared to what we will learn. We are going to set new books and throughout all the books of the old models. Now that money is programmable, monetary policy is now computer science. So I hope this video was informative. If you like this kind of content, please subscribe, hit the like button, and share this with your friends to help educate people on the general design of Bitcoin and to help remove Bitcoin maximalism from the cryptocurrency communities. All right, thanks.